Welcome to the Kevin Strong Show, and in this video we're going to talk about, are we moving towards a mortgage crisis in the United States? Everybody knows that interest rates have been going up at a rapid pace within the last 3 to 4 months. This is a very concerning problem. Not only is it a problem from an affordability standpoint, but obviously it can have a direct negative impact on the housing market. So let's talk about this broad topic, and I'm going to look at it from a different perspective. Just as a full disclosure, back in around 2004, I was actually a mortgage broker in the state of Ohio. So I have a little bit of firsthand knowledge on what this industry is about and how people get paid, and more importantly, what the psychological factors are when interest rates start to rise and how some mortgage companies handle those increased mortgage rates and how they basically handle it and how it affects their employees. So without further ado, let's get into this. I'm kind of going to go off of some notes that I have here. I'm not going to bring up an article or anything like that because I'm kind of going to wing it, so to speak. So this is why this is an alarming thing. Most people who work for a mortgage company is a commission-based job. There are some that have some kind of base salary, excuse me, but by and large, the ones who are really making good money, the incentive is the amount of loans you close, or the more loans you close, the more money you make. So most of the loans, as I was saying, are actually comes in two ways. Let me back up. So you've got internal and external leads. You've got a system set up where if you're a mortgage broker and your company is basically spending money, whether it be advertising dollars or marketing dollars online, direct mail, there's all kind of ways through public records to ascertain somebody's mortgage situation to say, hey, look, you're at a 6% rate or 5% rate. We've got rates at 3% or 2.85%. And if you finance with us, you can save X amount of dollars, some type of teaser to get the average consumer to say, hey, I can save some money here, or possibly if I have enough equity, I can roll some debt, get a cash out refinance, pay off a bunch of debt, put some money in my pocket, and potentially have a lower payment. So that's one way of generating leads for a mortgage professional. The other way is called being self-sourced. And basically what that is that you're responsible for your own leads. So typically people who are set up in that type of mortgage environment are going to go out and network with investors, real estate agents, and they're going to cultivate those relationships over a period of time where you garner some type of trust with those individuals to the point when they need a mortgage, they're going to go to you. So normally your leads are either coming in that are provided by the company and they're paying for it, or externally by networking and you're reaching out to investors and real estate agents and having business funneled to you that way. There are some exceptions to the aforementioned, but by and large, that's how it is set up. So less than, I think a year ago, I had a friend that had a 30-year rate. I think he said he got 2.85 or something like that. The 30-year fix is well over 5% now. They're going to continue to go up. This is going to, as I mentioned early at the onset of this video, it's going to exacerbate the affordability crisis because even when rates were at historically low levels, below 3% on a 30-year fix, the housing prices were going up at such a rapid rate that even a low interest rate was clearly keeping people out of the home buying market, and buyers were starting to get fatigued, and they kind of basically started to sit on the sidelines. So the psychology part of this is that you have some big companies like Rocket Mortgage, which is based out of Detroit, Wells Fargo, who does a ton, and I do mean a ton, of mortgage origination in the United States. They're arguably probably one of the top 10 mortgage originators in the country. And then there's a company out of Strongsville, Ohio called Union Home Mortgage. Well, all of these companies have one thing in common. They're starting to lay off in mass droves. So here's the psychology behind that. These are big players in the mortgage industry, guys. So understand this. When you're basically getting the majority of your money based on if you close a loan, that's how you get paid. It's a very heavy commission incentive type of position or profession. So these folks are spending a ton of money marketing, whether it be internally or externally. So when you start to lay off commission-based people, you don't see a turnaround within 90 days. The horizon looks bleak. Not 6 months and not 9 months. The horizon looks bleak because what happens is that you can't tell somebody or expect someone who's 100% commission to say, hey, John or hey, Jane, I'm going to lay you off for just 90 days. Hang in there. 100% commission-based job. And when things start to cool off and start to heat back up and the rates come back down, we're going to bring you back. A lot of these people have a certain lifestyle that's associated with in these professions in terms of living paycheck to paycheck. I'm not casting any dispersions on anybody, but I'm just saying by and large, you become comfortable with a certain standard of living. So when these companies like Rocket Mortgage, Wells Fargo, and Union Home Mortgage out of Strongsville, Ohio start to lay off, when you lay off commission salespeople, that's the lifeblood of your revenue source because those are the folks who generate the money. They are the ones who bring in the money in. So when the big players start to lay these folks off, they don't see any type of, let's just say, they're not optimistic about the mortgage industry, the housing industry in the immediate future, at least 12 months from now. And rates are going to continue to go up. The Fed is talking about raising the federal fund rate, which is the rate that banks borrow money from each other. They're talking about raising that up 50 basis points in May and multiple rate hikes thereafter for the remainder of this year. So I took some notes to kind of explain how all that works because a lot of people say, hey, Kevin, the Fed fund rate doesn't really affect mortgages. Well, indirectly it does, but directly it does not. So when the Federal Reserve makes more, when they make it more expensive for banks to borrow by targeting a higher federal funds rate, that's what they're getting ready to do in May, probably move it up 50 basis points. The banks in turn pass on the higher cost to the consumers. Voila, that's not a shock. Interest rates on consumer borrowing, including mortgage rates, tend to go up, and then short-term rates go up. Long-term rates typically also rise. As this happens in the interest rates on the 10-year Treasury bond, which influences the rate on the conventional 30-year mortgage, moves up. So basically what they're saying, there's a ripple effect. The federal fund rate goes up. That starts to impact various consumer borrowing instruments like credit cards. That eventually will spill over to affecting the 10-year Treasury. The 10-year Treasury will go up, and as the 10-year Treasury goes up, that typically will push 30-year mortgages up. So the direct correlation is usually the 10-year Treasury that's affecting the 30-year mortgages. But the precursor to the 10-year Treasury is what happens in the federal funds rate, how banks have to borrow money and at what interest rates. So finally, on that note, mortgage lenders set interest rates based on their expectations for future inflation and interest rates. The supply and demand for mortgage-backed securities also influence the rate. So I'm not going to get involved in mortgage-backed securities because that's like a secondary market that keeps the whole mortgage industry fluid and available to keep the oil in the engine going, so to speak. And I'm not going to go down that rabbit hole. But the last statement that I mentioned is kind of important. Mortgage lenders set interest rates based on their expectations for future inflation and interest rates. And this is why I'm saying this is very alarming when you have some of the big boys like Wells Fargo, Rocket Mortgage, and Union Home Mortgage laying off and other mortgage companies starting to lay off. They see something on the horizon that doesn't look helpful. It doesn't look sustainable, and they know they have to start reducing their sales force, which is the lifeblood of their company, because they don't think people are going to be able to go out and continue to originate mortgages at these high rates. So I hope you guys got some good information out of this. If you're enjoying this type of content, please do me a great honor, subscribe and share because you know I care. You know what my motto is, please keep your credit score up and your debt down. Please continue to watch this. This is going to have a negative effect on the housing market. Things are starting to cool off. I have a national program that I'm reaching out to sellers across the country, and I'm just kind of like saying, hey, I'm just being patient. They have an expectation of a certain price, and the housing market is somewhat lagging. So for sellers out there or prospective sellers, you have to keep in mind that the home price that you're seeking in May, because it's based on the way some home may have sold in February or March, we're in a totally different climate right now, not only from a standpoint of the housing market starting to cool down, but more importantly, interest rates are going up. substantially. The average payment, when you factor it in what the average mortgage is almost gone up like $400 or $500 a month. So when you consider an extra $6,000 a year of after-tax dollars that have to go towards a mortgage, and then you couple that with rising inflation, food, energy, gas. You see where I'm going here? It totally eats away at your disposable income. It erodes consumer confidence. And when consumers don't feel confident about their economic outlook, they stop making long-term purchases. Once again, I hope you enjoyed this show. This was the Kevin Strong Show, and I'll see you in the next video.